Hey everyone, welcome back. It is April 22nd. My name is Levi Woods. This is Drawbridge Finance. We are in it for, what am I doing? I'm getting distracted. So I thought I saw something on camera that, hopefully my audio is good. My screen for the minute is working. Look at this. Check this out. My silly splitter, my new splitter is kind of sort of working here for the minute. So hopefully, fingers crossed, it stays that way. If you could let me know what your, thanks Terry for letting me know. Let me know what you want to look at. We're going to pull some stuff up on Investing Pro. Obviously, the market is up today after a little bit of a sell-off yesterday. Let me just pull down this. Let me just, what is this? Make sure I've got everything going here and get this up on screen. If you've got some stocks you want to look at, one of the things that I've been really kind of trying to focus on this last little bit is some of these funds that are leveraged ETFs that pay out a high dividend yield. And let's clear that off of there. So that's one thing we're going to talk about today, but let's look at the market right now. SPX trading up 1.66%, a 52.44, and NQ trading at 18,256, up 1.8%. We were up over 3% on both of these earlier today. Russell up 1.93% at 1875. Dow Jones at 38,872, up 1.84%. So across the board, kind of positive day, all in the same sort of range. Everything's kind of moving together. VIX down, but still really high at 31.91, down 5%. US oil trading at $63. We saw it kind of bounce off those lows around that $60 level. And gold is the big one overnight. Last night reached 3,500 US an ounce. I'm going to turn off that Discord. Sorry, I know it's beeping in your ear. So kill that. If you guys have questions on Discord, please just ask them on the YouTube chat, and that is the best way to get a hold of everything. So gold overnight market was at 3,500 an ounce. We've seen this bull run all year. It's been wild to the upside. Is it going to continue? Possibly. You know, we still have a high volatility index right now, so we could definitely see some more upward push in gold. It may pull back, so we have to play with caution, of course, with all of these things. Apple trading at 198. It did break above 200 earlier today, up 2.97%. Playing fairly neutral on that. AMD still down considerably comparatively to its peers. I'm looking for some long deltas in that position and holding looking for upside move. ARK-K, I'm playing relatively neutral, slightly upside potential. Amazon's at 173. I'm looking at that as a buy. I would be long deltas on that. Baidu, obviously in the Chinese space, bullish on those overall. Chewy's been up recently. I would play neutral to slightly bearish on Chewy. Hood looking at 42.35. Haven't really been watching Hood, so no comment there. Meta 496. I've got a neutral plate on that. MicroStrategy, obviously Bitcoin up today as well. Did we get to that? So everything like MicroStrategy, Mara, all the cryptocurrency space are moving up today. Netflix had earnings earlier this week, moved up again another 5%. So having an absolutely killer time. That's one of the things I want to look at from a standpoint of these like yield max ETFs. Now, for those people that have smaller accounts and don't have the ability, you know, to play a covered call, if we're looking at Netflix, in order to play a covered call in here, this is a $100,000 position. Now, in general, when people are building portfolios out, you know, normally we don't want to hold about more than 5% at the absolute max in any one underlying. So if you extrapolate that out and you wanted to play covered calls on Netflix, it's really difficult to do that because you have to have a very massive portfolio so that a $100,000 position is only 5% of your portfolio, if that makes sense. So you'd be looking at like a 20 million account to have that $100,000 position. In the is that right? 2 million. I got to use my calculator for a second. 100,000 positions, sorry, 2 million. $2 million account. Was off by a decimal there. That happens sometimes, doesn't it? when we're looking at those positions, you think, well, how am I going to get to that place? You know, that's a large portfolio for a lot of people. When we have options here, we have positions like this Yield Max Netflix Option Income Strategy ETF. It pays out this massive dividend, 42%. And the way that they're doing that is by selling these covered calls against it. So they have holdings. If we were to look at what the actual holdings are, do I have it here? You'd have to do a little bit of research on these, but what they typically do, so companies like this, they buy leaps and then they sell covered calls against it, either weekly or monthly, and then they pay it as a dividend. But from a relatively cheap product, you know, $17 a share, 42% yield, they can generate a large amount of cash flow. And especially in a year where we're not expecting a massive amount of upside, when we have on positions like that are constantly paying out those calls, if Netflix doesn't continue to surge, this is going to, like, the covered call positions that they sell internally get paid out as a dividend, and they can generate a large amount of cash flow. So I've been doing a lot of research on that, a little bit of comparison. I'm going to show a chart that I'm working on. I'm just going to answer a couple questions. So we've got Paul's, what's your thought on AIL? I've been buying some in my long term. I'm not a super huge fan of airlines in this particular moment. Just in general, airlines are an extra thing. When we're faced with the threat of recession, and are people going to be spending money moving into airlines? Definitely are good valuations right now, but that we have to look at that future valuation and say, when is the turning point going to be? I actually think we're going to see a little bit more recession in the future, and so I think that will reflect in the airline prices. We're going to see those airline prices come down. It may not come down very much. I just don't think that now is the right entry for me for going long positions. Now, delta neutral positions on airlines, I think, are a fantastic position. But that's just my personal thought, of course. It's like, we have to look at those overall and say, is it a good time to buy? And when we look at a stock, let me just pull up a chart here and let's look at AAL on the 1 day chart. And, oh, sorry. Let's try that. Let's see if you can see that. AAL, let's take a look just on TradingView and see where we're at. So the $19 in January of this year, and now trading at what are we at here? Let me turn myself off. We're trading at 920, 909, 963 is this point of control. We're having quite a bit of volume at these levels, so this is where I think that we could see some neutral movement to the basically once we've hit this decent valuation. Now, it doesn't mean we can't come back up. If the earnings are great, then you notice, like, when we have good earnings here, this caused an inflow, another great earnings, and this caused the stock to really rally. And then this earnings came out as a beat, and then look at this. We saw this real retracement. So definitely under the 200-day moving averages, definitely something to consider. My play right now is not quite the entry yet. Jackson, hey Levi, did you hear you can retire early running $100,000 wheel on SoFi? Yeah, so, well, it's interesting that you say that. SoFi does pay a massive dividend. Let's take a look at SoFi Technologies. If you were to purchase back in January of this year, 1778. If we purchase near the high, stock's trading at 1133. That's a fairly large reduction in capital. When we're trading something like the wheel, the premium is massive on SoFi. So I understand why people want to trade it. The problem is with the wheel strategy in particular, the movement is extreme when it comes down. So where it would function very, very well is when it's trading in this range, which has done for the last couple of years. These are still relatively large swings, although the chart looks muted comparatively. When we look at levels here of $10 and then $4, if somebody was purchasing at $10 and it went down to $4, or even from 10 down to 663, that's a reduction in capital of about 40%. So these are large moves, even though they don't look very big. SoFi obviously has had a massive surge. We've seen a retracement. We're trading under the 200-day moving average, which isn't an uptick, but this is I think that these trades are best played as options. Now, the wheel is a better strategy than most to play on a stock like this, because if we're spacing these out like a month apart, and we were to sell a put, say we were to sell a put at a level, when the stock was trading at $18, maybe somebody sells like a 14 put, and then a month later the stock is trading at 11. Well, the next put entry is going to be at $9. What that is going to do, because it's a two-part play, you might have $14 and then $9. Well, it gives us an average right around the $12 mark. I think the mistake people make often with something unlike the wheel, whereas they just go all in and they're like, oh, it's going to the moon, we're going in all these puts at 14, and they have no plan of allocating some money at a lower price. That price may even be lower. The point of control, again, on this is $7.11. What we have to do with a company like that is take a look at what the current metrics are and what where are we here? Uh-oh, why is SoFi not coming up? Because I can't type, that's why. There we go. The fair value, $8.14. So this is why I use services like investing.com. I do have a link for them below if you guys are interested in checking them out. That fair value calculation really helps me a ton. When we're looking at stocks at $17 and it has a fair value of $8, it may not be the time to be long. That may be the time to be short deltas. And I can use that to help me along with that. So when I'm looking at something like Amazon, which I said earlier, I'm bullish on, one of the things that I'm looking at, I track that stock pretty closely. It's been in my long-term holding for a very long time. It's one of the ones that I watch and trade quite frequently. The fair value here. So if we look at the current value, 163, fair value is 210. That's 21% higher than the current price. These are good reasons for me to be bullish, because fair value calculation is like fundamentally where we're looking at as a stock trader. Like where can these stocks go based on what they're currently worth? That's really what's important. Dirty Scant says, hey, I paid off my mortgage last night instead of buying another Bitcoin. Any thoughts? Man, congratulations. That's awesome. I'm not a huge fan of paying down mortgages, but the reason that I'm not is because the money is cheap. I mean, I'm sitting right now on a fixed mortgage of 1.9%. Even if I took my entire mortgage capital right now and put it into just held cash, I would be making double what my mortgage is costing me. So for every day that I'm in my mortgage, my simple interest, no risk is making double. In times where mortgage rates are higher, and I'm Canadian, so my mortgage rate is a flexible item. Over every term that we sell, we're looking at deciding what we're going to do for that 3 or 5 year period. And I watch these things very closely. I think that for the most people, a house is like the biggest purchase that they make in their lives, and I think it's important to really delve into those numbers and to say, do these calculations make sense? And you guys know on my website, I mean, if you go back, I talk mostly about options on this, but if you go back a couple of years, I made tons of videos about mortgage calculations. It was an extremely important thing for me for a long time, because I was trying to leapfrog through properties to get myself to the level where I am now. I live in a beautiful castle-like home. We've got the pool and the thing and all the stuff. It's pretty amazing. I got there because of paying those interest rates. I got there from being strategic about my mortgage payments. So for me, paying down a mortgage for the most part is not something that's really in the cards, but I can look past it and I can look at the math and say, I know that these valuations work out in a certain way. The math, it's one of my personal rules, actually. The math always tells the answer. And so when I'm trying to make a decision as to one item or another, especially with fixed rate large purchases, you know, it kind of becomes a no-brainer. Now, where's the sweet spot? I think the sweet spot is around that 6.5%. So any mortgage over 6.5%, obviously it makes more sense to pay it down. But that's, again, just the math. Mortgage rates under 6.5%, why not carry them and see if we can make more money? But congratulations, that's fantastic. On Jamie says 2 million. Thank you for correcting me. That's way late, but you appreciate you jumping in on me. Counterintelligence. Hey Jeff, good to have you on. Would have kept the Bitcoin BTC, my dude. Yeah, I'm kind of with you. I still have BTC, and I am adding to my Bitcoin positions now. I'm actually adding a stock, a roundhill product called YBTC. And I like the payouts. We're gonna go over that in a little bit, so stick around. And I'm gonna show you a chart on some of these like super smart products that are out right now. And then counterintelligence, I see a lot of big names calling for 250K Bitcoin by year end. I mean, wouldn't that be great? I mean, they're on the run, you know. Definitely governments are working with Bitcoin. We're seeing an influx of that money into crypto. So in general, I think the crypto space, it could have a very nice year. Jackson says, I really can't say all those retire early YouTube videos out there. They make it sound like easy money for clicks and then people get clobbered, hate it. Absolutely, Jackson. You know, the wheel is, there's tons of wheel strategy videos. I'm guilty. I've made them. Is it like the best strategy out there? I think that people get hung up way too much on what their cost basis is when they talk about the wheel. For me, when I'm looking at those long-term covered call positions, it's twofold. I want to build the capital, which I know has risk on, and I want the cash flow off the calls to be high enough that it makes sense that I'm offsetting some of that risk. So as you guys know, I'm pretty aggressive with my covered call selling. I will sell in the money quite frequently. This helps reduce a little bit of downside risk when we see pullbacks. I will sell just barely out of the money to really cap that potential, but knowing that the return on capital is quite good. It makes me think I should share with you. Let me just pull up one of the many charts that I have. My options tier members have access to my rolling options record keeper. But I rolled some Mara positions this morning, and let's just take a look at like how the chart kind of works on a position like Mara. So just bear with me 1 second. I'll pull this up and then you guys can take a look. Close that. Okay. So this position, this is on Mara. Now Mara is a relatively small product. This position was opened in June of last year when Mara was at $20.10. Now I opened a buy right position. I bought 100 shares of stock. My options expiration, this was June 26th. The option expiration was July 19th. I sold the short call at $21, and I did this for a net debit of 1870. Now, for those of you who are doing the quick math, if I was to just purchase the 100 shares, I would have paid $2,010, but instead I paid $1,870. And my max profit on this was going to be a $2,100 sell, which would have given me a max return of, that very first trade, where would it have been, would have been one of these, this blue line likely. No, that's October. Where we buy right November. Which one is it? It's the blue one. It's blue for sure. July 19th. Yeah. So my max profit on that would have been there it is. Oh, jump in there. Come on. I don't usually have this hard a time selecting. That's the wrong one. Okay, I gotta zoom in. Sorry, bear with me. So this is when I started the trade. It's this this line right here, the max return would have been $230 for the July 19th. And that's what my profit profile looked like. It was capped at that point. And what I've done over the last year is I've continued to sell out of the money calls. When the stock went up to $24 a month later, instead of me letting it go called away, I rolled up from the 21 to the 22 and I collected 55 cents. And I use this as income generation. And the reason that I do this and I try to collect like a decent amount of credit each month that goes by is because I know that there's potential that the stock could drop. And it has. Here Mara is sitting at 1383. The interesting thing is that with all these adjustments, with these positions, and I actually have a position expiring later this week at 1450, my overall cost basis on this continues to drop. So if we were looking at my current position, my max profit on this is $97 at this point, which is not that much. But even if they expire this week and I just sell the shares off, I'm actually up $72 on this trade. And that I have been in for a year when it has had like a 45% reduction. And this is why I play those positions like I do. Now, if we were to look at one of my other Mara positions, when I have better entry. So this was opened, this one, that's April 9th. Let me just look through here. Which ones do I have? I've got August, July. I mean, I have a bunch and I do track them separately. This one was 16. I have one here that entry was at this was August 28th of 2023. And I bought it when Mara was trading at 1070. And we can see what happened. I was trading these positions and collecting premium on this. Well, where am I sitting now? You know, the stock is trading at 1385 and, you know, I've got a $1,000 return. My total capital at this point in time, my total debit is $500. From my initial $1,000 or what did I start, $800 that I put out, I have collected back $300 of this money over the last 600 days. If I was to cash this out now, I would have a very decent return on capital. And you can see that profit profile. This is why I trade on things like Mara. SoFi would have similar returns because the premium is so large. There's so much potential upside. And it's why I like to trade those. But we have to be appropriate about getting into the positions and making sure that we have a good entry. So you can see that I buy when there's opportunity and I am adding to these positions. I'm rarely selling them. You know, I like Marathon. I've done my research. I'm looking at that position. I'm looking at selling the cover calls, and I do that repeatedly over it. And I use that premium every time I collect to kind of set it aside and say, okay, here's my little cash kitty. And then when the opportunity arises, I will make those alerts, and I do those and I let everybody know. So if you guys are interested in my Patreon tier, you can see when exactly I'm entering all of those trades. For Mara, a very simple position like that, my covered calls, those are available in my dividend covered call tier, which is my lowest tier. You know, it's a small donation per month to my Patreon, and then you get those alerts, and you can be involved in the discussion in the Discord, and we can talk about any of this stuff anytime. You don't have to wait till Tuesdays to talk to me. You know, this is my public stuff that we do. Dirty Scan says, thank you. Paul says, agreed. I hold my 2.35 mortgage and keep cash and a high yield. Yeah, congrats, Paul. I think it's just math. It's just math. We're going back and forth a little bit. Mike Mueller says, man, these YouTube ads always start running just as you're about to explain something. Really? That's terrible. That, like, you know, it drives me crazy. Does it skip over? Is that what happens? Like, you can't, I don't even know. Does it just, I would hope it just delays. But John, happy Tuesday as well. And I actually set my ads at like the minimum, which is not good for me as a YouTuber, but I put that on because I don't want you guys to see a ton of ads. If I don't put any, then nobody new sees my stream. So it's a real catch-22. It's like I have to choose. I can put in like aggressive ads or balanced or minimum, and I put in the minimum because I think that, you know, I'm trying to provide this content to you, and I'm sorry that interrupts you guys. I hope that you're able to scrub back and see it. One one of those things, such as what we're doing. I lose the content when the ads start. Yeah, I guess you can always go back. Okay, well, what did you miss? What was I talking about? Okay. So if you don't want to do that kind of stuff, like those Mara positions, you know, I'm selling those repeatedly all the time. You know, there's one I really want to show you that in here, because I have like basically a free one. Just let me pull it up. Where is it's been? I've got lots of Mara positions, and I do track them all separately. This one, 600. I'm looking. Sorry, I know you guys can't see it. What? Why can't I find this now? But so many that I can't find what I'm looking for. This one right here. The Mara July 25th. So I entered this July 25th of 2023. So how many days is that? I've been in this particular trade for 640 days. My net debit to date, so if we count all the credits and all of the debits that I paid for this position, I'm at $111 total. If I was to sell these today, I would be here's my return on capital over 637 days. This is, you know, a compounding annual return of 321. This is doing like a super simple strategy. You know, there's the profit chart. At this point in time, the most amount of money that I can lose is $111, because from my initial position, and you can go through and see all of these trades in here, from my initial position when the stock was trading at $16.78, I sold a short call at $16, and I bought 120 shares for $17.96. And that has those in there, right? Yeah, 120 shares. So I still currently have 120 shares, and my total output to start that trade was $1,796. And then I let that expire, and then I sold another call, and I collected $380, and I collected, you know, 181 and 50 and 53 and 95. And these just add up. They all add up. You can see I paid a debit here. I rolled up to get myself a little bit closer to the money, but $43, $50, $29. These are not super aggressive. I mean, I do them weekly, but it's one of those things that there's times like this. From November to December, I only did one trade. And then from December to January, I only did one trade. I kind of slowed down, did February, did April. You know, you can kind of space it out and collect that money depending on how aggressive you want to be with the trading style. But that is the power of getting to a point where these are nearly free at this point. Like I could sell them for $1,500. My initial investment was only $1,700 to start, and now I've gotten $1,500 of that back, which is wild because I get to use that for more positions. Apparently YouTube can add ads to a stream even if you have ads off. That doesn't surprise me. You know, should we be buying Google? You know what? I'm like fully in the Google workspace, so I couldn't go away from it. I've been a YouTuber for a long time. I work with Google Sheets and try to design everything for that because it's so easy for me to like share and deal with everybody that's in my Patreon. And Google makes a ton of money. Fair market value right now, current value 153, fair value 171. That's 12% below. So when we're looking at adding good positions, this may be a good time to be long. How do we get long when we think that the tech industry has been beaten down too much? You know, do we buy something like QQQ, NASDAQ, or the QQQM, which is a little bit cheaper, you know, $182 a share? It's on sale for sure. We're at 221 and now we're at 182. That's a pretty massive move over the last couple of months. It's down 16% just from the middle of January. So we're definitely in a time where we might consider buying. The other thing we could look at are these leveraged funds like Roundhill Zero GTE Covered Call Strategy ETF. I just showed you how much money we can make playing a weekly position on Mara and how those covered calls, very simple. I don't vary that position. It's just like I own 100 shares or I own 120 shares, and then I just sell some calls against it. That's it. It's a simple strategy. They can be quite lucrative. These funds out here, like Round Hill Innovation 100 0DTE covered call strategy ETF, they're taking that to the extreme. They're saying, well, what if we sell a covered call every single day? How does that work? Well, you can see that the return over the last 3 months is down 20%. I'm going to pull up a chart. We're going to take a look at this together, and I'll show you kind of the returns of some of these positions. So bear with my my crude chart. This is for my own personal research, not for not really designed for a presentation at this point, but these are the types of things I'm looking at. So looking at a $10,000 investment, September 30th. I don't know if you guys saw the video that I did on these funds. I'm just doing some comparison. I'm like, what happens if I bought SPY when it was trading back September 30th, 573 with $10,000? I could buy 17 shares. I have a cash balance of 246. And then what I do is I look at what the dividend payout is, and if the dividend or the cash balance allows me to buy some shares. Now, one of the problems with playing SPY, even with $10,000, is I only get 17 shares. It's not very many. And when these dividends pay out, you can see here in December 19th of last year, $1.97. The dividend payout, when you only have 17 shares at $1.97, it's not very big. But cash balance increased from 246 to 279, 0 shares purchased. So I'm just ticking along, what's the investment change from that date, September 30th to now, inclusive of the dividends, we're down about 7.5%, which is not bad. We were on we had an extremely good year last year. We're down more this year than over the period from September. But what I wanted to do is I wanted to look at that and compare it to something like XDTE, which trades the S&P 500 as a long position, but trades 0DTE against it. And similar sort of thing, I take the $10,000, the stock price is much cheaper. I paid $52.73. I didn't actually do this, but I was able to purchase 189 shares. My cash balance was $34. Now remember, my cash balance only has to be just over $52 in order for me to purchase another share. So I kind of running a simulated trade and saying, okay, this is interesting. October 3rd, it pays a dividend 23 cents. I get 189 shares times 23 cents. Well, that gives me enough money, $73 cash balance, to all of a sudden purchase a share. So in this simulation, I buy that share, I purchase it for $52.46, and I now have 190 shares. That next week, pay out 20 cents. And guess what? I get to buy another share. You can see the frequency here of in a month, just with this $10,000 position, in a month, I was able to purchase 3 shares. The next month, same 3 shares. Then it was like 3 out of every 2 weeks. Then we started to see the market drop a bit. We got like a decent payout by 2 shares, 3 shares. Then every week in a row, and we skipped one, and then all of this has been quite lucrative all of a sudden looking at these. And it's one of the nice things about buying shares and dollar cost averaging into it. This position, $10,000 in September, 189 shares, has already grown to 219 shares if the dividends were constantly reinvested back into the product. Now, the NASDAQ, if we bought the NASDAQ, we don't get that dollar cost averaging in. You just buy it and you hold it. It's 20 shares across the board, even though there's small dividend paid out. QDTE, running that same scenario, we're at 234 purchased, up to 285. That's a huge move. Now let's look at the NASDAQ return over this time. The NASDAQ, this is the gray area here, dropped 8.48%. Well, if we look at the QDTE, it actually dropped 13.43%. So it actually had considerably more risk. Part of the reason for this is because it is a covered call strategy. During the day, the returns are capped. And so what I want to constantly look at is like, here's the comparison. This is IWM over from September, even with dividends reinvested, 14.97% compared to 16.13. And one of the reasons why I'm buying YBTC is because over the last couple of months, this return has been positive, 20% return since September. Now let's look, I charted these all together so we can kind of get a comparison as to what's going on. So this is with dividends reinvested. We can see these correlations. Now, the market has been down. This is not good for these types of strategies. We've seen some increased volatility. And what I wanted to do was chart it and say, okay, well, what would this comparison be if we were looking in a shorter duration where we've had this higher volatility? Because over the last couple of months, the roundhill products underperformed the standard IWM, SPY, and QQQ trades, which are these top lines. YBTC is this one that is far outperforming. And part of the reason for that is because the dividend is huge. It's like 50%. So I recharted this based on a start date of January, and I'm doing this kind of manually just to kind of play with the numbers. But I wanted to see a little shorter duration, and again, we've got I didn't get a chance to label these up, but XDDE is the green one. So this is green. Blue is SPY. So if we were here's SPY, here's the XTD equivalent. The Russell are the orange and pink. So the roundhill product slightly underperforming the IWM, and then the QQQ is the gray and the yellow, and again the roundhill product underperforming. But the biggest winner of all of these from January is still this YBTC. And if we get into a consolidation phase, if we start to trade sideways, I can see that these positions are going to quickly catch up, because what's happening is we're getting into a position where the stocks are down, and so that constant dividend that's being paid out weekly on these funds is paying us that dividend and allowing us to buy in at these lower rates, and we can consolidate those positions. So for somebody that maybe purchased like $40,000 worth of the 4 of those positions over the last year or in the last couple of months, we're looking at a fairly substantial drawdown in those. But boy, are the positions on sale right now, and the cash flows coming in and allowing us to buy them at these great valuations. The other thing is there's no exposure. The only exposure that's capped is during the day. So there's still overnight upside potential, which I really like. That's one of the things that I love about it. Typically when I'm trading covered calls, because I do it manually and because I don't have time to come in the morning and trade them and just hold them for 6 hours, the way that I do it is I put on a position and it is capped the entire time. And I don't like that. I feel like it's an inferior way of trading. Wouldn't it be better if I was only capped while the market is open and I have overnight exposure, which is fantastic. This gives me faster cash flow and allows those high dividends. So that's kind of why I'm looking at those things in general. Thank you for the likes, by the way. I appreciate it. If you guys have any questions about any of the products that I'm looking at or that you're interested in, or you want me to do a little review, just type the tickers right into the YouTube chat. I'll stick around here for a bit. I feel a little bit today like I'm not going to do the full hour. I've been playing with this idea of being like, am I keeping my streams too long? Are they too short? So I'm sorry to hear about the ads. That's terrible. But I do have a few minutes here. So if you guys want to jump in with some tickers, let me know, and I'll pull them up on Seeking Alpha or investing.com, and we'll take a look at what is going on. I'm also going to pull up, while I'm waiting for you guys to type away and be an active part of the chat, which I very much appreciate that you guys are. It's always so good to see everybody here. We've got a great group of people here. So Terry's here, Kevin's often here, John's here. John is here. I love that you guys are able to join me each week. It's fantastic. It makes me feel good that we can do this together, and we can try to navigate the craziness that has been the market in the last little while. Here's the S&P 500 chart. I'm just looking at it in the bottom right, just right next to my face, and looking at this one-day chart. What's happened here? Did we freeze? Oh, fantastic. There we go. We back? This is the NASDAQ. That's not what I want. I want the S&P 500 one day. Just looking at, let me turn myself off here. On this one day chart, we had a lot of volume. There was a lot of volume up here in this upper range. When we were trading here in December, January, there was a ton. There's been light volume down here. This, to me, this is part of why this market is so whippy. When I see this kind of stuff, I think, well, we're just going to move. We're going to break one way or the other really quickly. because the volume has been so low. I took an interesting trade yesterday. I should pull it up. You know, I was just looking at where do we have? Do I have one? I think I've got it here somewhere. The trade that I took. Let me. I closed Discord. The trade that I took. Somebody load this up. But if you go out in time, on these down days when we're seeing a ton of pressure to the downside, if you go way out and look at options that are like December of 2030. So what is that? That's like almost 5 years out. I was able to buy a contract, a debit call spread. And I bought it at the most ridiculous strikes you can get. I went up to an 11,000 strike. So an 11,000 strike would mean that in order for me to make money, if I'm buying an 11,000 strike call, the S&P 500 would have to double between now and 5 years from now, in order for it to start making money. And then in order to offset the cost of it, I sold the 12,000 call. So I'm like way up there. You know, we're talking the S&P 500 would have to double over 5 years, which could. It's not very likely that it's going to, but it could do that. Those positions, I was able to buy that spread, which has a max payout of $100,000. I was able to buy that for 22. What did I pay for it? 23.30. I think I paid for it. 23. I'm just looking at my screen. 23. I think I paid 23.35. Did I get that yesterday? So for a $2,200 investment, I was able to get a huge amount of long deltas. And really, when you look at the profit profile of something like that, for $2,200 max risk, you know, what happens? If it doesn't go to 11,000, then I lose $2,200. That position that I put in and alerted on my Discord yesterday made $750 overnight. This move, this 2.5% move to the upside, just pumped it full. If the market was to rally up to 6,000 level, and where are we? We're sitting, the SPX is at 5278, and that 6,000 level, as you can see in this bottom screen, is not that high. You know, like we were, you know, up here at 6140. If that position goes to 6,000, if SPX goes back to 6,000, anytime basically this year, that $2,200 position more than doubles. And it's wild that we can get that kind of premium. The other crazy thing about it is that, say the market had continued down, well, I have a short call that's 5 years out. So let's just say the market did drop another 10%. That call would be less and less money, and I would probably buy it back. And what that would do is it would give me an unlimited potential to the upside, absolutely unlimited. So if there was a continued downslide on a long-term position like that, you know, I might dump another couple $1,000s into it, but I would still have no more risk than, say, about $6,000 total. And then I would have unlimited potential to the upside. And I can play with that. You know, I can sell that call or buy back the call when the market drops, and I can sell the call when the market goes up. And in this case, it basically just gave me long delta exposure for a very low cost. And it's a very interesting thing when we're in these high volatility environments and looking out at those longer term plays. You know, are there opportunities out there to make money? And we don't have to always sell premium. We can sometimes buy. So I'm really trying to play both sides of the field and say, okay, well, you know, if we're in a position where the market is down substantially, like, can I potentially make money on those? And there's some opportunity out there, which I love. So specifically, that was the December 2030 contracts, and I sold the 12,000 call on SPX, and I bought the 11,000 call on SPX, which seems ludicrous that we would even be able to play something like that out there, that far out. What else do we have here? We've got Jamie says, Paul says, appreciate your time. I am glad you appreciate it. That's awesome. Jamie says, on your ETF comments, do you think the other high yield ETFs are good, like AMZY and YMEG versus the Roundhill products? Let's take a look. I had that the Netflix, which is Yield Max. Let's look at AMZY. So this is Yield Max as well. The dividend yield, with these, like the dividend yield of 41%. I mean, it's down. If you look at 3 months, it's down 18%. So it has been absolutely slaughtered. But when you're bullish something, when you're bullish Amazon in general from these levels, and you're looking at the 1 year chart, the 1 year chart is only down 0.53%, and the dividend yield's 41%. So holding this over the past year would have been a 40% payout and allows us to buy things that are low. So I'm starting to really look at these and think that they're pretty awesome. Especially with this price point, like $14. I mean, I've traded covered calls on Amazon. They're big positions. Like it's just big, and they're sucky moves and they generate money, which is great. But especially for people that have small accounts, like why would we not be, putting these in small positions and seeing how they go? If we dollar cost averaged into this over the course of the year, you're buying some down at $13.50, some at $14, $15, some at 17. You're not able to buy as many at these high valuations anyways, and you're buying more at the low valuations. By dollar cost averaging, we always get the best of both worlds, because if we're using dividends to buy in, we're buying more when they're cheaper and we're buying less when they're higher. So that automatically helps, just from a math perspective. Now, are they going to continue? The structure is such that the dividend yields should stay pretty high. Now, the problem is that they are slightly inconsistent. So you do have to kind of go through and really analyze what's going on. So if we look at something like this, why is this one doesn't even have anything that's recent? 2024. So these were all declared, and then we've got, so is this just, okay, yeah, so they are monthly. These ones are monthly. So this is we'll look at the record date. That's the one that you have to own it. So if you own shares on November, you got $1.17. If you owned in December, you got 86 cents. Well, this is where the dividend was quite big at those times. But then we've got a 40-cent dividend, and 54 and 41, 48, 58. And this is where I like to kind of track these and say, how are they functioning? That's not liking me. How are they functioning over time? And a lot of these are pretty new. Like this one didn't have any. There's no data past September of 2023. So, but 47 cents, 63 cents, 54. Looking at the most recent data, I can kind of extrapolate that for every share that I'm getting around 45 cents. Well, 45 cents a month on a $15 stock is wildly good. So, and then YMAG, this is probably an interesting one. I'm assuming it's I haven't heard this one, but I'm assuming it's the Magnificent Seven. So just from the name, Yield Max Magnificent Seven Fund of Option Income ETFs. And so we're looking at this record date, pay date is weekly. And we're getting so this is 9 cents, 9 cents, 9 cents, 8 cents, 14 cents. So over the course of a month, 4 payouts, we're looking at about under 40 cents for the last little while. And what's the price is $13.79. So that dividend yield right now, looking at around 51% annually. Has this had as big a drawdown? The 1 year chart on this, because it's spread out over 7 different positions, is 6.8% return on top of the 51% yield. So we're looking at like a 58% annualized return for doing nothing other than buying some stocks for $13.79. For, you know, and for Canadians, for this type of position, like I have to buy these in my RSP, because if I buy them in my TFSA, I have withholding tax, and if I buy them in my margin, I've got withholding tax. So I can buy them in whatever account I want, but I am not getting that full yield if I buy them in any account other than my RRSP. So, and it's one of the RSPs kind of suck, really, but they serve some purposes. And one of the things that we can do, especially for buy and hold investors, like buy those, reinvest the dividend. Pretty awesome. So thanks for pointing this out, Jamie. I think the individual stocks are the ones that have the biggest returns relative. So when I look at like those Roundhill products, the XDTE, XDTE is my least favorite of them because the yield is so small. For those premium sellers out there, we know that we get our biggest bang for our buck for selling against the Russell or the Qs comparatively to trading against the SPX. So why don't we apply that same theory to these ETFs? And the numbers work out. We see that there's more volatility, but then there's more potential. So I want to target more potential. I don't mind taking more risk if there's more potential. It's that, where are we? I also have trades on, like my patrons know, I have trades right now on Tesla, Visa, Meta that have zero risk, absolutely none, and huge profit spikes. This is the cool thing about being a trader that does a ton of analysis. Like we are looking at these things and saying, okay, can we build something that is completely riskless? Because this is a volatile time. I want to trade options. I don't want any risk. Can we do that? Yes. What is the risk of these positions? Well, the risk is not making as much money. I have the potential of making somewhere in that 7 to 15% annualized return this year. But I also have the potential of only making 1.8%. That's the risk factor that I am willing to take. Taking a small but positive return, but potentially making a larger return. These are positions we can add, and that's kind of the discussion that's going on in my Discord group right now. So if you have been, looking at a time to sign up and say, well, what are we doing? How do we protect ourselves? That's what I'm doing right now. I'm putting on positions that have on the downside, I make a little bit of money, and then I still have some potential, rather than just going all crazy all in when we're at these levels. Mike says, always appreciate your time. Thank you so much. James says, thank you. You're welcome. Counterintelligence. I hold MSTY and it's down a bit, but dividends is taking me to even. Yeah. And anybody that purchased the S&P 500 SPY this year, like if we look at SPY right now, if anybody that bought this in January of this year, it's like, where are we here? Just January. Can we do 1 year, 3 months? I just want to look at this. So we're January. If we bought at the beginning of January, for those investors that did that, 582. Well, it's currently at 526. That sucks. Like that's 12% down. If we can get to even, we're doing well comparatively. So a return of something like MSTY, which is, MicroStrategy. Okay, yeah, this would be a good one. Dividend yield 75%. Over the last month, over the last 3 months, it's down 4%, and it's paying out a dividend of 75%. That dividend is so big, and so we're getting some opportunity. That's one of the biggest ones I've seen. So thanks, Jeff. Appreciate that. So, and also CNY. Okay, I got to write these down. I'm going to have to go back and watch my own stream. That's what's going to happen. This is good information today. 780, 71%. Yeah, so this is coin. So these are specifically, this one's on coin. Yeah, I love this. I like what? This is great. And right now, $7.80. Like, wow. Over the last 3 months, this one's down 30%. So this one is a good opportunity to buy now, but the dividend yield is not making up for that loss on that MSTR or the MSTY rather. Definitely has made up for that. Over the past year, if we were in this for the year, it's done extremely well, you know, down 17% with a 71% dividend yield. I'm okay losing 17% if the dividend yield's that big, because what's happening is I'm constantly buying in at lower prices. It's actually better if this went down constantly and that yield stayed that high. I'm basically paying out, I'm getting 71% of larger position forever, for perpetuity, and it just keeps paying more and more cash. And at some point you just say, okay, well, now I just take the cash, you know, and these are now out here for us to take without doing any work, you know. It's wild. So thanks for these. Mike Mueller says, these income ETFs sound perfect for long-term Roth IRAs since there are no tax implications. That's one of the big things that we have to look at. So for us as Canadians, like I would pump these into my TFSA, which is similar to a Roth IRA, but I'm even more aggressive. I feel like my returns on trading of options and covered call strategies in my TFSA are getting the same, if not better, returns than these. But I think that there's a potential there. So if there's the ability to have the income tax free, then fantastic. But for me, because my TFSA, which is my tax free account, if I do it individually, the options income, I get 100% of the options. I'm not getting a cut. When I get it paid out as a dividend, they take whatever it is, 15% withholding tax. So that kind of cuts into the return, and it makes it a little bit of an offset. So definitely when we're looking at aggressive funds, tax-free accounts have to have our most aggressive positions in it, because we want to make the most amount of money, because the benefit is only in the tax-free portion. So the positions have to make a lot of money, if that makes sense. 11:58, we're just down to the end. How do you wheel things such as XDTE when they are marked hard to borrow? So I am not wheeling. When you say, we've talked about this before, S. Smith, that I am not wheeling XDTE. I'm buying the shares and I'm collecting the dividend. That's it. That's the strategy. I am not selling puts against it. I'm not selling calls against it. I'm not selling them short. Borrowing typically would mean selling them short, but those positions, because they already generate the covered call strategy inside, I have no need to sell calls on top of it. I could cap the potential even more and sell calls against it, but I don't need to. I don't feel the need. So I'm just buying shares. That's it. Is there options volume on XDT? I can sometimes have covered calls against my Misty, but sometimes there isn't the volume. I haven't looked into it. Sorry, Jeff. I did look this morning just to see on the RDTE. It was trading at $30. I was only going to be able to get 15 cents theoretically for selling the May 32 call, and RDTE is trading right now at RDTE is trading at 31.10. So I would be capping my upside at 90 cents above and getting 0.5% for a month. And I was like, okay, that's 6% a year. Is that worth it? You know, it's here nor there. I think that if we get a bit of a run, which we could, it probably is not smart to be holding those cover calls. And when there's not enough volume, you're getting poor pricing. Then when we have to buy them out, we're getting poor pricing. So we'll see what happens. It just depends on, it really depends on pricing. That's more important than volume, because if you can get the price, then it's great. But I find with these types of things, typically the prices start to all of a sudden get filled. We get filled on covered calls when the price is just about to start running up. That's why we get filled. So you always end up missing out on the up run, if that makes sense. Okay, it is 12 o'clock. My phone is ringing. I'm going to get out of here. You guys are amazing. Let's get rich together. If you have an email, if you have a question or anything you want to email me, send me an email. And I will see everybody on Thursday for my members only stream. Sorry, I'll see my members on Thursday. I'll see everybody else next Tuesday. Thanks so much, everybody. Take care. Bye.